Okay, hi everyone, Daryl here. Okay, this is lesson 35 in my Investing 101 YouTube playlist. And today we're going to talk about the Federal Reserve System. And for you guys who are not familiar, the Federal Reserve System is referring to the Federal Reserve System of the United States of America. And this is very important for us as investors to know whether we're investing in properties or equities. The US economy is actually the largest economy in the world, and whatever the Federal Reserve does, it has a bearing on all other economies throughout the world. Okay, so like recently, a lot of people have been seeing that the Federal Reserve chairman made an announcement that they will set the Fed funds rate lower, and we'll touch on this in later lessons. And then essentially, this affected uh, interest rates across from where I come from, Singapore. So essentially, they helped us to lower the bank interest rates for mortgages, and then people who purchase property or took up a mortgage or refinance, they could refinance at a lower rate compared to a couple of months ago because the Federal Reserve lowered their interest rates, and we'll touch on that at a later lesson. Okay, so the Federal Reserve System, also commonly known as the Federal Reserve or the Fed, a lot of people refer to it as the Fed. It's actually the central bank of the United States of America, and it controls and regulates the monetary system in Singapore, in US, in order to smoothen economic cycles of the US. So there are three key objectives for monetary policy. The first one is actually to maximize employment. So if the Federal Reserve sees that unemployment is particularly high, then it may uh, try to lower the interest rates or tweak monetary policy so that it will encourage businesses to employ and expand. Then it also has to stabilize prices, so it helps to smoothen out and control inflation, keep inflation in check, and it also moderates interest rates. So this is one of the things that a lot of people have interest when it comes to investing or purchasing property. Is actually interest rates. Okay, so the current chairman of the Fed is actually Jerome Powell. There's another uh, portion of the Fed that we have to be familiar with, which is actually the Federal Open Market Committee, which is actually the one that goes out and uh, tries to purchase government bonds or increase or reduce the flow of money out in the market. So like open market operations are things whereby the Federal Reserve will go out. They call it like expansionary monetary policy, and go out and make purchases in the market, or sell government bonds, or sell treasury bills, so that they can use these as tools to increase or reduce uh, money supply. And we'll touch on this later also. Okay, so one thing to note is that the Federal Reserve or the Fed is actually independent, so it's not under the control of the President of the United States of America or any other legislative committee of the US government. Okay, so there's a fixed term that the Fed chairman will serve, and just because there's a change in the president, right, doesn't mean that the president can change the chairman of the Fed. The Fed is not the Federal Reserve Chairman Jerome Powell doesn't have to answer to the current president of the United States of America. So it's supposed to be totally independent. It's an independent body within the US system, and it doesn't answer to the president or any other legislative committee of the US government. Okay, it's actually the lender of last resort, and the Fed played a very key role. It was crucial in saving the US economy during the Great Recession in 2007 to 2009. So I'm quite sure that a lot of people are very familiar with the Great Recession. So what happened was that the US economy was actually going under. So like even investment bank like Lehman Brothers fell. And what happens was that uh, yeah, a lot of people are losing their jobs, and um, companies were going under. So even things like AIG, Bear Stearns, all these companies were going under. and the Fed actually came in, and it was the lender of last resort because capital froze up, so no one wanted to lend any money to each other. So the Fed actually had to come in and say that we are the lender of last resort. So if you want cash, right, here it is. And they actually pumped money. They placed money into the balance sheets of many of these teetering financial institutions, and then it was the lender of last resort, and that's one of the main reasons why the US actually survived this Great Recession. But in all honesty, because of the severity of how bad the Great Recession was in 2007 to 2009, the medicine, so-called, that the Fed actually prescribed and administered on the US economy was pretty intense. And even till today, right, we are feeling the effects of this well, I'll say that this injection of stimulus. So the economy has been stimulating for a pretty long time. In all honesty, we have had over 10 years or 11 years of growth already, and there are many people who have not seen a recession yet because of how the Fed has been stimulating. So those people who have been out working in the last maybe 10 years, right, they don't know what's a slowdown. Yeah, one of the main reasons is because our economies have always been expanding for the last decade or so already. And it was because the Federal Reserve came in and they stepped in, and they pumped money into the system to try to stimulate the US economy, and it trickled down to many other open economies, especially an open economy like Singapore's. Yeah, so I'll touch on other aspects of this Federal Reserve system that would complement this. And yeah, and I'll see you in the next video.